So, imagine a company telling Wall Street, like right out of the gate, hey, we just lost $128 million this quarter.
Right. I mean, that's a heart attack number.
Exactly. The algorithms just instantly kick in, the headline hits the terminals, and, well, the stock should theoretically tank, right?
Absolutely.
Because that is a massive, alarming number for literally any business. But what if you looked closer at that exact same financial report, peeled back the layers of all the, the accounting magic?
Paper losses, yeah.
The paper losses, and you realize that their core business actually generated like $1.6 billion in profit over the year.
It's wild. It's truly wild.
It is. So today on Talk Tickers, we are looking at U-Haul, ticker symbol UAL. And we're digging into this massive illusion that is just hiding in plain sight on their balance sheet.
Yeah, and I got to say, it is one of the most fascinating disconnects between headline numbers and the underlying business health that we've seen in a really long time. Because when you are a retail investor scanning through earnings reports, you are basically trained to look for that bottom line earnings per share, right?
Right, the EPS. It's the first thing everyone checks.
Exactly. You see a negative number and your instinct is just to hit the sell button immediately. But doing that here, it completely misses a brilliant, albeit really painful, structural pivot that's happening under the hood.
And that is exactly why we're doing this deep dive today. Our mission, as always, is to cut through the Wall Street jargon, look at the cold, hard numbers from U-Haul's Q4 2026 earnings call, and figure out what this actually means for you and your portfolio.
Because you really have to look past the flashing red lights here.
Right. We want to see if management is actually setting up like a massive win for patient shareholders. So let's just get the bad news out of the way first.
Let's do it. Lay it out.
I'm going to hit you with the raw, unvarnished numbers from this Q4 report, and honestly, they do not look pretty at all.
No, they are brutal on the surface. There's just no sugarcoating the net income line.
None. So U-Haul reported a fourth quarter loss of $128 million. Now, for context, in the same quarter last year, they reported an $82 million loss.
Right.
So the loss widened significantly. And if we zoom out and look at the full fiscal year of 2026, their earnings just plummeted to $83 million.
That's a massive drop.
The huge drop from the $367 million they earned the previous year. And if you are tracking earnings per share, it's a Q4 loss of 65 cents per share. That's down from a 41-cent loss the prior year.
Yeah, and the initial reaction from anyone reading those figures is just pure panic.
I mean, how could it not be?
Right, because you have widening quarterly losses, you have full year earnings practically falling off a cliff, and the negative EPS is just growing worse.
And this is a big but.
Yeah, the silver lining here is a metric that tells a completely different story. Like, it reveals the actual cash being generated by people out there renting trucks and storage units.
Okay, lay it on us.
So despite all those net losses, their adjusted EBITDA, and just for the listeners, that's earnings before interest, taxes, depreciation, and amortization. Their adjusted EBITDA for their core moving and storage segment actually increased.
Wait, increased?
Yeah, increased.
How do you lose more money but increase your earnings? That makes no sense.
Well, it went up by $6 million for the quarter, reaching $223 million.
Wow.
And you look at the full fiscal year, adjusted EBITDA actually grew by $26 million to hit a staggering $1.6 billion.
Okay, I have to stop you there because for the retail investor listening right now, this sounds like absolute voodoo math.
It really does.
How on earth does a company report a significantly bigger net loss to Wall Street, but simultaneously show an increase in adjusted earnings to the tune of, $1.6 billion for the year? We need to ground this in reality.
Let's do it.
It's basically like buying a $50,000 brand new car in cash, right?
Okay, yeah. Good analogy.
Your overall net worth on paper drops the exact second you drive it off the lot because the car's resale value just plummeted. You feel poorer.
Right, the depreciation hit.
Exactly. But you didn't actually spend any new money today out of your checking account, and your daily salary from your job is actually still going up. The loss is on paper. It's in the value of the asset, not in your daily cash flow.
That is the perfect way to visualize it. So the salary in this scenario, like the core money coming in from operations, is actually growing.
Right.
Because people haven't stopped renting U-Hauls. They haven't stopped buying moving boxes. The business of moving things from point A to point B is doing just fine.
So where's the leak?
Right. The leak in their net income isn't in their daily operations. The leak is sitting right out in their parking lots.
Ah, okay.
And it comes down to one of the most vital concepts in asset-heavy investing, which is depreciation.
Okay, let's translate this for the listeners. Walk us through the mechanics of depreciation and exactly why it is dragging this company's bottom line down so violently right now.
Yeah, for sure.
Because an EPS loss of this magnitude doesn't just happen by accident.
No, not at all. So to understand U-Haul's earnings, you really have to understand the staggering scale of their physical assets.
Yeah.
I mean, they own hundreds of thousands of vehicles.
Right.
And roughly half of that massive Q4 EPS decline came from one single line item on their income statement. Just one.
Which was?
Truck fleet depreciation.
Wow. Half.
Half. To give you the hard data right from the transcript, their depreciation expenses jumped from $181 million in the fourth quarter of last year to $221 million this quarter.
That is a massive jump.
It is. And for the full year, it went from $693 million up to $879 million.
So that is nearly a $200 million increase in depreciation expense alone.
Exactly. Just in depreciation.
So let's break down the why and the how here. When U-Haul buys a truck, they don't just expense the entire cost of that truck on day one, right? Accounting rules require you to spread the cost of that asset over its useful life.
Right. That spreading out is depreciation.
But why such a massive, sudden jump of $200 million? I mean, what happened? Over the last couple of years, specifically for the 2023 and 2024 model years, U-Haul had to buy cargo vans in a market where vehicle prices were incredibly inflated.
Oh, wildly inflated.
Right, so they paid absolute top dollar just to secure the inventory.
They were caught in the macroeconomic crosshairs, basically.
Mm-hmm.
I think back to the supply chain crises of those years. You had the semiconductor shortages.
The auto manufacturing halts, yeah.
Right. So vehicle prices, especially for commercial fleets, were historically high. But U-Haul is in the business of renting vehicles. If they don't have trucks, they literally don't have a business.
They can't just tell customers, sorry, we are waiting out the market.
Exactly. They had to buy them to meet consumer demand and protect their market share.
And they didn't just buy a few vans. They expanded their box truck fleet by over 14,000 units in a single year.
14,000.
But here is the mechanical trap they fell into. They bought high. And fleet management relies on a very specific life cycle, doesn't it?
It really does. You buy a truck, rent it out for a few years, and then you sell it into the used vehicle resale market to recoup a chunk of your capital.
Right, but when U-Haul went to sell their older vans recently, the post-pandemic economic reality had completely shifted.
Completely.
The buyers in the resale market simply weren't willing to pay those inflated prices anymore. Used car prices have softened dramatically.
Which forces a really harsh accounting reckoning. I mean, management had to look at their books and realize, okay, our estimated salvage value for these vehicles, like the price we thought we could sell them for, is way too high.
Right, the math was broken.
Yeah. So to fix that legally and ethically on their balance sheet, they had to materially increase their depreciation rate.
Gotcha.
They had to take the financial hit right now to match the reality of a softening used vehicle market. They are essentially catching up on the lost value of their fleet all at once.
So if you are an investor looking at that EPS loss, you have to realize that this depreciation is a non-cash expense.
Exactly.
It's an accounting mechanism to reconcile the paper value of the fleet. It does not mean $879 million in actual cash flew out the window this year.
Not at all.
If we strip away the paper losses on the trucks and look at the actual cash coming in the door from customers, the underlying business is surprisingly resilient, isn't it?
It is. The operational numbers tell a story of a very healthy consumer base. I mean, equipment rental revenue, the absolute core of what they do, increased by $12 million in the fourth quarter.
$12 million.
And for the full year, it was up 2%, which translates to an additional $86 million.
Okay, so the trucks are doing well?
Yeah, and it wasn't just the trucks driving this. Storage revenues were up 7% for the quarter, generating an extra $16 million.
Wow, 7% is solid.
Yeah, and their average revenue per occupied foot, which, by the way, is the holy grail metric in the storage business.
Oh, for sure.
That improved by over 6%. So they are successfully charging more for their space, and customers are willing to pay it. In fact, their average new customer rental rates are up about 3% year over year.
Now, wait, I want to focus on that storage side for a moment, because while a 7% revenue increase sounds great, there is a number buried in this earnings call that looks like a massive red flag.
Oh, I know the one you're talking about.
Yeah, U-Haul reported that their same storage occupancy was down 540 basis points, landing at 86.1%.
Right.
For anyone tracking commercial real estate or self-storage, losing over 5% of your occupancy sounds like a total disaster. That means you have thousands of empty units sitting around gathering dust, not making money.
It looks terrible on a spreadsheet, I'll admit that.
Right.
But this requires us to ask a much deeper question. Who exactly was occupying those units before they emptied out? And this is where the nuance of this specific earnings call is absolutely critical for you to understand. Management clarified that of that 540 basis point drop, 450 basis points of it was entirely deliberate. Deliberate.
Why on earth would a company intentionally drive away customers to the point of lowering their occupancy by nearly 5%? That sounds crazy.
Well, because they weren't driving away paying customers, they were driving away dead weight. Back in the second quarter, U-Haul instituted a massive system-wide cleanup program.
Yeah.
They essentially ripped the Band-Aid off and aggressively evicted delinquent accounts.
Oh, wow.
Yeah, these were people who had belongings sitting in units for months, perhaps longer, who simply weren't paying their bills.
Let's explain how this happens in the real world, because it's pretty common. You have local storage managers running these facilities, right?
Sure.
And their performance metrics, and sometimes even their bonuses, are often tied to keeping the facility full. So human nature takes over. If someone is 2 months behind on rent, the manager might let it slide, hoping they eventually pay, because kicking them out means the occupancy rate drops and the manager looks bad to the regional directors.
Right, they're protecting their numbers.
Yeah. The local facility looks full on paper, but the cash register is totally empty.
Exactly. And we have to distinguish here between physical occupancy and economic occupancy.
Okay, break that down for us.
So physical occupancy just asks, is there stuff in the room? Economic occupancy asks, is the stuff in the room actually generating revenue?
That's a huge difference.
Huge. Before this corporate cleanup, local managers might have looked at a facility that was 95% full and felt great about their physical occupancy, completely masking the economic reality.
Right.
U-Haul's corporate management finally stepped in, audited the real cash flow, and forced the entire system to focus strictly on economic occupancy.
So they initiated the eviction process. And evicting someone from a storage unit isn't just throwing their stuff on the curb.
No, it's a whole ordeal.
There are legal notices, auction processes, labor involved. It is painful and time-consuming. But they took all of that operational pain at once.
They did.
They cleared out the non-payers. And while that makes the headline occupancy number look bad, dropping down to 86.1%, it actually opens up that real estate.
Exactly.
The CFO noted they now have roughly 35,000 more units available across the country. They can now rent those units to people who will actually pay the new higher rates. It's making the underlying business fundamentally healthier.
It really is the ultimate example of sacrificing short-term optics for long-term cash generation.
100%.
I mean, they took a short-term accounting hit on the truck depreciation, and they took a short-term optical hit on their storage occupancy numbers.
And Wall Street hates both of those things.
Wall Street algorithms hate them because algorithms just read the headlines. But a human being analyzing the mechanics sees a company cleaning house and positioning itself for higher margin revenue.
Okay, so we understand the reality of the operations. The cash flow is strong, the storage business is cleaned up, and the depreciation hit is basically a paper loss based on past vehicle purchases.
Right.
This brings us to the future. What is U-Haul management promising going forward? Because there was one massive announcement on this call that completely shifts the narrative for current or prospective shareholders.
Yeah, this was the big one. The board of directors just authorized a $350 million share repurchase plan.
A $350 million stock buyback. Okay, why is this such a pivotal signal for U-Haul specifically? Because companies do buybacks all the time.
Right, they do. But it is significant here because it represents a total, strategic 180 turn.
Really? How so?
For years, U-Haul has operated in a hyper-aggressive growth phase. Their first instinct has always been to plow every spare dollar of capital back into expanding the business.
Right,
They were buying real estate, building massive multi-story self-storage facilities from scratch, expanding the truck fleet by tens of thousands of cargo vans and box trucks. They were a capital expenditure machine.
They were burning cash to build physical capacity because they wanted to capture the pandemic moving boom and didn't care how much it cost to get the assets in place.
Exactly. But now they are abruptly pumping the brakes.
It's hard.
Yeah. Management explicitly stated on the call that they have built so much physical capacity over the last few years that they are going to take at least a year off from aggressive growth.
Wow, a full year off.
Yeah, they're going to let consumer demand naturally catch up to the massive supply footprint they've built.
Let's give the listeners the hard numbers on this reduction in capital expenditures, or CapEx, because it is staggering when you look at the scale.
It really is.
Net equipment purchases, which is the money they spend on new trucks minus the money they recoup from selling old trucks, are estimated to decrease by around $560 million next fiscal year.
$500 million less being spent on equipment.
Let that sink in. They announced there is zero planned growth for the box truck fleet next year. The only things they are actively growing are their U-Box portable containers and their new toy hauler trailers.
And this pullback isn't just limited to the vehicle fleet either.
Right.
The real estate development for their self-storage segment is also slowing down materially. Last year, they had 8.1 million square feet of self-storage development in the pipeline.
Okay.
This year, that has dropped to 7.2 million square feet. They are methodically turning off the spending spigot across the entire enterprise.
You know, it reminds me of a family that spent 5 years maxing out their credit cards and taking out massive loans to build lavish extensions on their house.
Oh, that's a great way to think about it.
Right. Like, they added a third floor, a guest house, a pool. They were constantly surrounded by scaffolding, dealing with contractors, and all their free cash was just going out the door to fund the construction.
And it looked chaotic.
It looked totally chaotic, and their bank account was always drained. But finally, the construction is done. They've stopped. They've put away the hammers. The contractors have gone home. Now, they're just going to live in this massive, beautiful house and use the money they were previously spending on construction to pay down the mortgage and build wealth.
Exactly. Because they currently possess the most storage and fleet capacity they have ever had in the history of the company.
The house is huge.
The house is fully built. They view that capacity as a coiled spring. And while they wait to fill up those 35,000 newly emptied storage rooms and rent out those 14,000 new box trucks, they find themselves generating a massive amount of free cash flow.
Because they aren't spending it.
Right. Since they aren't spending $560 million on new trucks, that cash just piles up. And management has looked at their current stock price, determined it is trading at a discount compared to the intrinsic value of these assets, and decided the absolute best use of that cash flow is to buy back $350 million of their own shares.
Let's explain the mechanics of a share buyback for you, the retail investor, because it is crucial to understanding why this is a bullish signal.
Yeah, let's break it down.
When a company buys its own stock on the open market and retires those shares, the total number of outstanding shares decreases. Imagine a pizza cut into 10 slices.
Okay, I love a pizza analogy.
If you own one slice, you own 10% of the pizza. If the company buys back 2 of those slices and destroys them, there are now only 8 slices left.
Right.
Your single slice just became a larger percentage of the total pizza. By reducing the share count, every remaining share you hold represents a larger claim on the company's future earnings and assets.
It fundamentally alters the math of earnings per share. Even if the company's total net income stays exactly flat next year, the EPS will go up simply because that income is divided by fewer shares.
Exactly. It's just math.
It is a classic, highly effective move from a mature, well-managed company shifting from a capital-intensive growth phase into a cash harvesting phase.
So we've dug into the headline numbers, we've unraveled the mechanics of the depreciation drag, we've explored the intentional drop in storage occupancy, and we've analyzed this massive $350 million pivot toward cash harvesting.
We covered a lot.
We did. Now we need to synthesize all of this. For the retail investor listening right now, trying to figure out if U-Haul is a buy, hold, or sell, how do we interpret this earnings report?
Well, I am taking a firm, undeniable bullish position on U-Haul based on the underlying mechanics of this call.
Okay, defend the thesis. We know the headline EPS was terrible. Where is the actual upward pressure going to come from the next 12 to 18 months?
It comes down to 3 specific catalysts that are aligning right now.
Let's hear them. Catalyst number 1.
First, let's look at that massive drag from depreciation that destroyed their net income.
The $800 million gorilla in the room.
Exactly. The worst is mathematically behind them. Management specifically noted on the call that the second derivative, which is the rate of change of the depreciation growth, is finally slowing down.
Oh, that's huge.
Yeah, they are actually seeing sequential declines. Because they are halting box truck purchases entirely next year, they won't be adding new, high-priced assets to the fleet. The depreciation on the existing fleet will naturally taper off.
So the violent accounting pain that spooked Wall Street is in the rearview mirror.
Yep.
Okay, so the bleeding stops on the balance sheet. But stopping the bleeding doesn't necessarily make the stock price go up. What is catalyst number 2?
The transition to the cash harvesting phase. By halting that capital-heavy expansion-cutting equipment purchases by $560 million and slowing real estate development, they are freeing up a literal river of cash.
Right.
Diverting that cash into a $350 million stock buyback provides a massive floor of support for the stock price.
Because the company is buying it.
Exactly. The company itself is stepping in as a guaranteed buyer of the stock. This transition from burning cash for growth to returning cash to shareholders is highly attractive to institutional investors who look for yield and stability.
And catalyst number 3.
The setup for future earnings comparisons.
The year-over-year game.
You know how it works. Wall Street algorithms and analysts run on year-over-year comparisons. They want to see growth relative to the same quarter last year. By instituting that delinquency cleanup program this year, U-Haul took all of their operational pain at once.
You took out the trash.
Yes. They artificially depressed their occupancy numbers this year by evicting non-payers. That means when we look at the earnings calls in fiscal 2027, the year-over-year comparisons are going to look fantastic.
Oh, because the baseline is so low.
Exactly.
Yeah.
They won't be fighting the drag of delinquent accounts. They will simply be filling up clean, available units with paying customers at higher rates. The comparisons are going to make it look like a massive growth story when really they just reset the baseline.
Wow. To summarize this for you, algorithmic trading and headline scanners will look at that $128 million net loss, assume the business is failing, and hit the panic button.
And they'll be wrong.
Right, because if you take the time to look at the mechanics of the underlying cash flow, the $1.6 billion in adjusted EBITDA, the deliberate end of the hyper-expansion cycle, and a management team that is actively stepping in to buy back shares, you should see an undervalued opportunity.
Completely agree.
The storm clouds on the accounting side are breaking, and the core cash-generating engine of renting trucks and storage spaces is running hotter and more efficiently than ever.
It just requires an investor to be patient and to look past the next quarter's headlines, but the fundamental foundation they have built is incredibly solid.
So we have a clear picture of the core business. But before we wrap up this deep dive, there was one final, incredibly provocative thought that came out of this earnings call.
Oh, I've been waiting for this part.
It has literally nothing to do with depreciation or storage occupancy, but it speaks volumes about how this management team views their brand.
Yeah, this was easily the most fascinating moment of the Q&A portion of the call.
It really was.
An analyst pitched what sounded like an absolutely brilliant, almost unignorable idea for generating new revenue. U-Haul owns hundreds of thousands of trucks.
Right.
These trucks are driving all over the country, constantly visible on highways and in neighborhoods. They're essentially rolling billboards.
Yep.
So the analyst asked management a very simple question. Why not sell advertising space on the side panels of the trucks?
I mean, it seems so obvious. Imagine a massive McDonald's, Coca-Cola, or Geico ad on the side of a 26-foot U-Haul box truck.
The analyst estimated that given the size of their fleet and the visibility of the assets, this could generate $500 million a year in pure incremental profit.
$500 million.
Yeah, that is $500 million of revenue with virtually zero cost of goods sold. You just print a vinyl wrap and slap it on a truck you already own.
$500 million for a company that just reported an $83 million net income for the year. An extra $500 million in pure profit is astronomical.
It's game-changing money.
It is basically free money lying on the table, but management shot it down immediately. They didn't even say they would study it. They just said no.
They rejected it outright.
Yeah.
And their reasoning was entirely focused on brand equity and community relations.
Interesting.
First, they cited concerns about confusing their brand image. They want customers to look at their trucks and instantly know that U-Haul is a reliable partner for moving and storage.
Right.
They don't want their core utility muddled by associating with soda, fast food, or insurance companies.
But is brand purity really worth $500 million a year?
Management argued it is. Furthermore, they pointed out the logistical nightmare of dealing with local zoning boards and community regulations.
Ah, the red tape.
Right. Many municipalities have strict ordinances regarding mobile advertisements and rolling billboards. U-Haul already has to navigate complex zoning laws just to build their storage facilities.
That makes sense.
They argued that irritating local governments by flooding their streets with rolling corporate advertisements would create immense friction for their core business operations. They believe the purity and utility of the U-Haul image is vastly more valuable long-term than a short-term cash grab from third-party advertisers.
Which leads us to our final question for you to chew on today. We live in an era where literally every square inch of our world is aggressively monetized.
It's so true.
Your phone screen, the gas pump, the grocery store checkout, everything is an ad network. Attention is the ultimate currency. In that environment is U-Haul's strict dedication to their brand purity, a sign of principled, visionary, long-term thinking. Are they protecting a trusted 80-year-old brand from becoming a cheap gimmick? Or are they just stubbornly leaving $1 billion of high-margin revenue lying in the street out of sheer corporate stubbornness?
It is the ultimate debate between intangible brand equity and raw, measurable cash flow.
It makes you wonder how much a reputation is actually worth on a balance sheet. Just something to think about the next time you pass that classic white and orange U-Haul truck on the highway. See you next time on The Deep Dive.